is a substrand of strategic investments, right? So strategic investments are made with some motive other than, right? So the motive, the intention is to either gain control or significant influence over the investee. Yeah. Let's look for a good font here. Okay, that's better. The intention behind the investment is to either gain control or significant influence over the investee. And so when you do not have control, so when the percentage ownership is between 20% and 50%, then there is likelihood of there being significant influence. But you must look for additional factors. What are those additional factors? There's 5 of them. Does the investor have representation on the board? Does the investor, or is the investor able to participate in key decision making? Are there significant volumes of intracompany transactions? Have the two companies engaged in exchange of key managerial personnel? And finally, is there or has there occurred exchange of important technical information? These are 5 additional factors that you must consider before deciding whether there is significant influence or not. Other types of strategic investments. So this one here, when you have significant influence investments are called investments in associates. And that is basically what topic 4 is about. This topic is about. Next week, we will be looking at investments in joint ventures. Right? So investments in joint ventures is where control is shared, right? So control is shared by the co-venturers. Right? So that's another kind of a strategic investment. Another kind of strategic investment that we will be learning about in this course later on is an investment in a joint operation. And there too, control is shared, but this is shared now between the co-operators. Okay, we will learn about these distinctions in this course. And then finally, there would be an investment in a subsidiary. And the investment in a subsidiary is where the percentage of ownership is greater than 50%, or there is a contractual arrangement giving the investor company control. And if that were the case, then we will be looking into consolidations. So it's these guys, investments in associates and investments in joint ventures, that are going to be our examples for the equity method, all right? So we're going to be learning about the equity method, investments in associates and investments in joint ventures are reported using the equity method. So IAS 28 applies to investment in associates and investment in joint ventures. And under IAS 28, we apply the equity method of accounting. Now, you folks may have come across the equity method in accounting 240. If you took accounting 240 a while ago, you would have come across that. If you didn't, then you would have had another chance of coming across the equity method in accounting 315, the first intermediate accounting course. However, my understanding is that at SATE, especially in the evening classes, there's not enough time. And so sometimes instructors may not go into a lot of detail. Okay, so they may end up not going into a whole lot of detail there. And if that were the case, then it's sad, but it just means that I have to do some heavy lifting at this point in time. So just for the benefit, I'm seeing the number of people that are actually sharing this file. I posted a link, right? I posted a link. I'll just send it again if you don't have the link. Please make sure that you click on that link. The link is there in the chat box, and you should be able to access this file, and you can actually, can someone confirm if you're able to put your own comments or notes on this file, or is it just viewing? Try putting in a comment. I thought I had shared it with for commenting.
It's just viewing.
Really? That's no good. Let's change. Anyone on the internet with this link can comment, it says. So why is that? Okay, let's just change it to editor. But then please, for heaven's sake, don't go in and make changes to the work that I do, all right? So hopefully this will change.
Sorry, if you right click on the cell, it'll allow you to comment.
Well, that's what I meant. So you should be able to put in comments for your own sake, right? So that was the intent. Because now mayhem can descend. Now if people start typing, they could end up. So now if one of you, just on random, if one of you start typing, let's see. Can you please go ahead and start typing? Let's see if that'll interfere. So others are not able to see what you're doing. So that's a good thing. You're not able to see what you're doing, but so this was, who was this? Anonymous Loris. So this is all anonymous here. And Lovely says they put a comment, testing, and I see a yellow ribbon. So yeah, that's basically what my intent was, that you should be able to put in your own comments, right? So this is what I meant, right? So the actual typing is what, like, so I could type in something and someone might inadvertently go in and overwrite what I've done. Okay, so I'm just going to rescind the editing privileges. Okay, so I'm going to put it back to commenting. So you can put your own comments. So if you just right click, you can put some, just something to help you remember. something that I didn't write, but something that'll help you remember. You can have your own notes, and this basically gets saved automatically. So I think if you saved it to Drive, this file will be saved at your end automatically. You don't need to worry about losing it or anything. Okay, so this can be a little bit helpful with the collaboration. Okay, so equity method of accounting. The initial investment is recorded at cost, and cost includes transaction costs. So if there were any brokerage fees, commissions, and so on paid, those brokerage fees, commissions, etc., will be included in cost. Subsequently, investment income is calculated as follows. Investment income will include the investor's share of the investee's net income. So if the investor owns 20% of the investee company, the associate, then 20% of the associate's net income will be the investment income for the investor. But to that amount, there will be adjustments adjusted for. And basically, there are three kinds of adjustments that we must make. First one is for amortization of fair value differences. Okay, so amortization of fair value differences. That's one. Secondly, any goodwill impairment. And thirdly, any intercompany profits. All right, so even if you learned about the equity method, it's highly unlikely that you went all the way to intercompany profits. This idea about eliminating intercompany or adjusting for intercompany profits and amortization of fair value differences and so on, it's vital for before we actually start learning about consolidation. So when we do consolidations, folks, consolidation is basically the equity method in play. There's a lot more to do there, but if you have a good understanding of the equity method, you will be able to understand and learn consolidations much better. So this is part of the reason why I have moved the discussion on both the investments in associates and investments in joint ventures early in the course. Okay, you will go through. So this part will seem hard. Okay, this is intentional on my part. This will seem difficult, but anything that seems difficult at first, with familiarity, we get more used to it. And so it seems like it's getting easier. It's all psychology. So I'm actually literally throwing everybody here into the deep end of the pool. But by the time we get to consolidations, you will have either got customized to it or you will have withdrawn from the course. I hope it's not the latter, but I don't want the course to seem like, oh yeah, there's nothing in this class, and then we hit consolidations, and then I don't know if you've heard about horror stories, but I myself took consolidations at SAIT back in the day when I was working on my CGA, and man, roughly half the class used to fail, and it was like a big moneymaker for SAIT at that time. And I really don't know how much things have changed. Like I've heard of stories about people taking the course multiple multiple times. I had one person that I remember vividly. He took the course, I think, 6 times, 4 times just with me. So it wasn't the person, it wasn't the instructor, but eventually, like, he made it. And I don't want to wish it on anybody here in this class, right? So just trust me here. It'll seem like a hard passage, but things will get better as we go, as we move along. That is part of the reason why I have structured this course way differently from how the textbook flows. Some of you may feel a little bit of anxiety around that. Trust me, if you do what I tell you, if you do as I say, you will more likely than not succeed. Okay, so investment income is calculated. We will go into the numerical examples of those. Conceptually, you got to remember that any dividends received from the associate will reduce the investment account. Right? Any dividends received from the associate reduce the investment account, and the investment income increases the investment account. All right, so if you were to take a look at what the investment account will look like, so investment account, the investment in associates, there'll be a beginning balance for every year. The investment account will increase with the investment income. So the investment income will cause the investment account to go up. And any dividends received from the associate will actually cause the investment account to go down, such that at the end of the year, the balance reported is going to be the beginning balance plus investment income minus the dividends. Is that okay? If you're interested in journal entries, when the investment is purchased, the journal entry would be debit, investment in associates, and credit, cash, I guess. Next up usually is dividends received. Dividends are received on that investment. You'll debit cash and credit the investment in associates. End of the year, you will debit the investment in associates and credit investment income. Okay, these are the 3 common journal entries that you'll encounter when you're applying the equity method. All right, so do you guys have any questions at this point based on what you watched in the video? Was there anything that kind of stuck in your mind, or maybe something that coming back from an earlier class and you wanted to clarify? before I dive into numerical examples. Okay, I'm seeing none. Thank you, Lovely, for the encouragement. So we're going to look at that first example. Example 4-441. These are all examples taken from the lesson notes. So here I have, on March 1st, 2001, Alpha Limited purchased 10% of 500,000 shares of Gamma at $15 per share, plus transaction costs of $5,000. Now, 10% of 500,000 is 50,000 shares. 10% is not quite enough to get us to significant influence. So primarily, you want to look at percentage of ownership as being between 20% and 50%. Now, it is possible for significant influence to exist even with less than 20% ownership. But in that case, you must have additional supporting factors. Additional supporting factors here: representation on the board of directors, taking part in key decision making, significant volumes of intercompany transactions. The companies have exchanged key managerial personnel, and there has been exchange of important technical information. So in 4.1, if you look for any of those additional factors, so 10% by itself is not enough for significant influence. Now, if you look for additional factors, other than the fact that there is some intercompany sale of goods, $20,000, right? $20,000 of intercompany sale of goods. Is that material? Is that significant? Well, Gamma's total net income for the year was $400,000. So the volume of the intercompany, so this is after taxes, 400,000 is after taxes. You apply the tax rate and so on, and we're not sure if the volume of intercompany transactions is significant. And even if it were, for a moment, that's just one factor. There's nothing else that indicates that Alpha Limited is able to exercise significant influence either by having a seat on the board of directors or being able to participate in important strategic decision making, whether Alpha Limited sent any key managerial personnel like the CFO or controller or somebody, over to Gamma. So nothing in addition to the 10% indicates significant influence. So the first requirement of this question is, how should Alpha Limited report its investment in Gamma for the year 2001? And to answer that question, you really must consider if Alpha has significant influence over Gamma. Now, this isn't an answer, this is an outline of an answer, okay? This is not the actual solution. So you will write up your own solution here. The outline must include, you have to check or consider, evaluate if Alpha actually has significant influence over Gamma, over the investee. So here, as I said, the facts do not appear to support that conclusion. So you have to talk about the percentage ownership and additional factors. And taking both into account, it doesn't seem like Alpha has significant influence. So if Alpha does not have significant influence, then this becomes a passive investment. So for passive investments in shares, last week we talked about those. Passive investments in shares, fair value profit or loss is the default. It is possible for Alpha to make an irrevocable election to apply fair value OCI. That's got to be a choice. It has to be made in the year of the acquisition. So there are two possibilities. Now, based on the information here, you'll have to make a recommendation at the end, right? Because the question is explicitly asking you, how should Alpha report its investments? You have to make a choice. Right? Don't leave it, oh, Alpha can go either way. You have to make a choice. So say you made a recommendation of fair value profit or loss. If you recommend that, then give a brief description of how the fair value profit or loss model is applied. What happens in that case? The investment account will be reported at fair value on the balance sheet. Transaction costs, dividends, and gains and losses, whether realized or unrealized, they are all reported in net income. Okay, so that would make for a strong response to that part of the question, how should Alpha report its investment in Gamma for the year 2? Sorry, folks, the phone started ringing all of a sudden. So any questions so far? Okay. So once we have dealt with this initial part, then we can get into the nitty-gritties, prepare financial statement extracts, and provide supporting calculations. So how will Alpha report its investment in this case? If we've gone with the choice of fair value profit or loss, then we know that Alpha is going to report the investment on the balance sheet under current assets. Fair value profit or loss investments are reported under current assets. Will be a short-term investment, a trading investment, right? And the investment itself will be reported at fair value. On the statement of comprehensive income for the year, any dividends will be reported as income. Transaction costs will be expensed, and any remeasurement gain or loss on the investment, remeasurement to fair value, will be reported as part of net income. You go back and take a look at the numbers. The shares were purchased at $15 per share. At the end of the year, Gamma's shares had a market price of $17.50. So the shares have gone up by $2.50 per share, from $15 to $17.50. $2.50 per share. The fair value at the end of the year is $17.50 per share. How many shares does Alpha own? 10% of 500,000. 10% of 500,000 works out to 500,000 times 10%, 50,000. If each share is worth $17.50, then the fair value is 50,000 shares times $17.50, $875,000. Right? So that $875,000 is what the investment will be reported at. Short-term investments in Gamma, $875,000. That's the fair value. Well, what did the investment cost us? 50,000 shares times $15 each. The original cost, sorry, I think I had an extra zero there. The investment had originally cost us $750,000. So there is a unrealized gain of $125,000 on the investment. During the year, Gamma paid a dividend of 75 cents per share on June 10th. So on each share, we got a dividend of 75 cents. So a dividend of 37,500 has been received. And the transaction costs of 5,000 must be expensed. So these three items will be reported on the statement of comprehensive income under other revenues and expenses. Dividends of 37,500, transaction costs will be expensed, and the unrealized gain will be reported in the income statement portion. So this would be the numerical example. This here is the verbal explanation of, still in the world of fair value profit or loss. We've not crossed over to the equity method. It's still last week, right? It's still last week's material. Okay, any questions on this part? All right. Then if you're ready, let's make our transition to example 4.2. And in the case of example 4.2, what's going to happen is we will be continuing with the facts provided in example 4.1. So in the next year, in the year 2002, so this one here was 2001. In the following year, 2002, Alpha Limited purchased an additional 10% of the outstanding shares of Gamma for $19 a share. And this purchase gave Alpha Limited significant influence over Gamma. So now do we need to consider additional factors? If we are told that there is significant influence, do we need to consider additional factors? No, right? So if we are told, we will take that at face value, unless this was like a CFI case. In that case, you will still be kind of considering, even if management insists that they have significant influence, is there really any evidence of significant influence? But I'm not taking you down that rabbit hole, Chase. So if we are told that Alpha gets significant influence, then we know that Alpha needs to stop using fair value profit or loss and start using the equity method. Hugo has a question. What if someone else had 20% or more as well? So I will give you another extreme example, Hugo. It is entirely possible someone else actually owns more than 50% of shares of Gamma. So the other party that owns more than 50% will have control, right? So they will be the controlling entity. So think about old days when, well, I mean, there's still kings and queens in the world, but in the olden days, kings would still have counsel, right? Kings would still listen to the counsel. So it is possible that someone may have the year of the king. So king is in power, the king would be in control. But if the king listened to somebody's advice, would we say that the person that the king listened to, she had significant influence over the king's actions? And by extension, over the entire kingdom? Yes, right? So it is possible for significant influence to exist, even if the investee company is controlled by another company. The only thing to keep in mind in my example is that the king actually listens to the advice. All right. So if we own 20% and somebody else owns 60%, if the other company listens to what we have to say, if they pay attention to what we have to say, then we would argue that we have significant influence. So consider the likes of Warren Buffett. Berkshire Hathaway will never go out and take control over other companies. They do have control over other companies as well, but oftentimes they're able to secure a position, right? So Berkshire Hathaway recently took on a position in Barrick Gold, for example, right? They bought a certain percentage. They didn't buy a whole lot, right? I think it's still less than 10%. But I can imagine that the management at Barrick Gold will definitely want to pay attention to what Warren Buffett and Berkshire Hathaway have to say. Even with a a considerably small position, Berkshire Hathaway can, if they want to, exercise significant influence. It kind of comes down to the facts on the ground. Okay, so there must be evidence of cooperation, willingness to pay attention, right? So if you see those things happen, then you can continue to have significant influence. If not, well, then I might as well, it's like being the parent of a teenager. Say if the teenager is 17, 18, whatever, the age of being emancipated and so on, I might be the parent, but if they care two hoots for what I have to say, right? When the kids are younger, the parents have control. As the kids grow older, right? I mean, one would argue that we certainly lose control over the kid. We might even cease to have any influence over their actions. We hope that never happens, but that's the possibility. Okay, so it doesn't matter what percentage. You got to look at the facts. Okay, does that make sense to everybody here? That was a very valid question. Alrighty then. So the outcome of this particular additional purchase is alpha got significant influence. So now when we answer the question, how should alpha report its investment in gamma? We would say, okay, now that we've obtained significant influence, alpha has to use the equity method. There's no choice here. They have to use the equity method to report the investment in gamma for external reporting purposes. And so what happens at this point is that the 50,000 shares that Alpha owned in 2001, the existing shares, they have to be remeasured to fair value on Jan 1st. So remember, the fair value at the market price on December 31st was $17.50. Alpha got significant influence on Jan 1st, and they paid $19 a share. So these 50,000 shares from last year must be remeasured to fair value, right? So they'll get bumped up by $1.50 per share. Existing shares must be remeasured to fair value. The resulting gain will be reported in net income. After that, Alpha's total percentage ownership will now become 10% from last year, plus an extra 10%. Alpha will now own 20%. So 20% of Alpha will report its proportionate share here is 20% of Gamma's net income as investment income. Subject to adjustments. What are the adjustments? We talked about the adjustments. Adjustments for amortization of fair value differences, goodwill impairment, and intracompany profit. And so in this particular case, the fair value differences related to, so if you read the blurb here, at this time, the fair values of Gamma's net assets equaled their book values, except for the following. There was inventory whose fair value exceeded book value by 50,000, equipment whose fair value exceeded book value by 500,000, and long-term debt whose fair value exceeded book value by 75,000. For these three items with fair value differences, there will be amortization of fair value differences to account for. Alpha will also need to adjust for its share of intracompany profits. We will talk about intracompany profits soon. There's information here that will become important for us for that purpose. Dividends will reduce the investment account balance. And at the end of the year, we're given a market price for Gamma's shares. Well, guess what? We will no longer adjust the investment account to fair value. We'll stop reporting the investment at fair value. So some kind of a summary of the equity method will be expected as part of that written response. And then subsequently prepare financial statement extracts. Well, that's easy enough. On the balance sheet for the year 2002, the investment will now be reported under long-term investment. It's no longer a current asset, but a long-term investment. And what will be reported in the statement of comprehensive income under the other revenues and expenses portion, which is basically the net income portion, is the investment income and the gain on reclassification from fair value profit or loss to the equity method. So the existing shares, remember I said, have to be remeasured to fair value. Resulting gain will be reported in net income. So that gain on reclassification is to be reported under net income. Okay. Any questions so far, or shall we dive into the math? All good. So the investment in associates, you'll have to calculate that amount. The investment income, we will have to calculate that amount. The gain on the reclassification is relatively easy because for that, we have to look at the fact that we had 50,000 shares that had been measured to $17.50 at December 31st, 2001. So their book value is 875,000. On January 1st, 2002, with the purchase of additional shares at $19, the existing 50,000 shares get a bump up by $1.50. $19 minus the $17.50. So that bump up, 50,000 shares times $1.50, gives us the gain on reclassification of $75,000. You could basically consider the journal entry instead, if you like. So we had the short-term investments brought forward from last year, right? We had the short-term investments in Gamma, 875,000. That will be credited now that we are converting the investment into an investment in associates. So we'll debit investment in associates and credit short-term investments, 875,000. Credit the cash, 950,000, and that's for the purchase of the additional 50,000 shares now. Total number of shares becomes 100,000. 100,000 shares multiplied by $19 gives you 1.9 million for the investment account. The difference is the gain on reclassification. Right, so that should not be too challenging. 50,000 shares were the existing number of shares. The share price went up from $17.50 to $19. The change, $1.50 multiplied by 50,000 shares gives us 75,000. Okay. Now, for the other calculations, we have to be a little bit cautious. So the investment in gamma, we will calculate taking the beginning balance. So the beginning balance of the investment is basically the 1.9 million. That's the acquisition. Well, that is the acquisition cost of the investment, 1.9 million. We will reduce the investment account by the amount of dividend, because remember, dividends reduce the investment account. Dividends are not income, they actually reduce the investment account. So if you go back and take a look, during the year, Gamma paid a dividend of $1 a share. Now, Alpha Limited owns 100,000 shares now, yeah? 50,000 from last year, 50,000 purchased in addition in the year 2002. So that's a total of 100,000 shares. Dividend of $1 a share, the math isn't that particularly difficult, I guess. So works out to 100,000. $100,000 of the dividend will reduce the investment account. The investment income will make the investment account go up. We don't know what the investment income is just yet. We have to calculate it. So how do I calculate the investment income? For the calculation of investment income, I will be taking Alpha's share. So Alpha owns 20%. I will be taking Alpha's share of Gamma's net income for the year 2002. Right? That's got to be my starting point. Yeah. Come back. Investors' share of investees' net income. So investor share, Alpha share is 20%. Investees Gamma, 20% of Gamma's net income. So Gamma's net income for the year, go back and take a look. For the year 2002, Gamma earned net income of $600,000. So Gamma's net income, 600,000. Alpha is going to pick up 20% of that amount. Right? However, there will be additional adjustments. There'll be additional adjustments needed for amortization of fair value differences. So fair value differences at the time of acquisition, the fair values of Gamma's net assets equaled their book values. Net assets simply is total assets and total liabilities. Total assets minus total liabilities equals net assets. You also know net assets is also called by the term shareholders' equity for a company. Total assets minus total liabilities is nothing but shareholders' equity. So at the time, January 1st, 2002, Gamma's net assets equal their book values except for inventory, equipment, and long-term debt. These three items had book values that were different from their fair values. All right. So inventory had a fair value $50,000 more than book value. Okay, and if you're wondering what might be the reason for that, well, remember that inventory is reported at the lower of cost or net realizable value. Now, this is so when Alpha Limited purchased the shares of Gamma, in case some of you have taken accounting 415, accounting theory, you may have come across the concept of market efficiency, that at a given time, the stock price reflects all information that is publicly available or publicly known about the company. And the markets have a good way of sort of determining the price. So usually you'll find the market price of a company tends to be different from the book value. So you may have come across something called the price to book ratio. So usually the market price under normal circumstances, the market price of a stock tends to be more than its book value, right? It could also be sometimes be that the price is lower than book value, because then the market feels that the company has got some assets that are essentially not worth as much as they are being carried on the books. That might call for possible impairment losses, right? So you think about recent reports by Aurora Cannabis. Aurora Cannabis had massive write-downs on some of their long-term assets because they were overvalued on their books. So the market price tends to anticipate these things. So when Alpha had to pay out $19 a share, so as an aside on this particular bit, if you just consider what did Alpha Limited get when they shelled out $1.9 million for a total of 100,000 shares in Gamma to get significant influence. Remember, Alpha only got significant influence by dint of their 20% ownership, right? So for them, significant influence cost $19 a share. $19 times 100,000 shares is 1.9 mil. Now that 1.9 million, what did that get, Gamma? So what that gets, and I'm just going to add a comment here, this 1.9 million, so the purchase price is made up of three things. A, as a shareholder, right? Alpha Limited owns 20% of the common shares of Gamma. So by dint of that, Alpha Limited owns 20% of, so I'm just going to go here. So this purchase price is made up of 20% of Gamma's shareholders' equity. Shareholders' equity, another term for shareholders' equity is net book value, right? So Alpha Limited, when they paid $1.9 million to acquire significant influence, they got in return 20% of Gamma's shareholders' equity. They also got 20% of fair value differences, right? And thirdly, whatever is unexplained is put under goodwill. Okay, so this is what the $1.9 million that Alpha Limited paid for Gamma is made up of. It's made up of Alpha's share of Gamma's shareholders' equity. Now, how much is Gamma's shareholders' equity? Well, on the date of acquisition, Gamma's shareholders' equity was $7.5 million in total. $7.5 million in total was made up of $2.5 million of common shares and $5 million of retained earnings. So that 7.5 mil is for the entire company. Now, how do I move this guy? Okay, right here, you can always click watch. So 7.5 million was Gamma's net book value. Alpha has scored 20% of that. So 20% of 7.5 mil is $1.5 million. What did it cost Gamma? 1.9 million. The difference between what Gamma paid to get significant influence and what its percentage ownership of shareholders' equity of Gamma is, the difference is the acquisition differential. That's what we call it, acquisition differential. Now, what is this acquisition differential made up of? The acquisition differential is always made up of two things: fair value differences that we can actually explain, and goodwill for what we cannot. So acquisition differential of 400,000, we'll first try to explain it by reference to the fair value differences. And we say, okay, inventory for Gamma Limited was worth $50,000 more than the book value. Now, because the market price paid by Alpha must reflect the fair value of Gamma, then definitely the price that Alpha Limited has paid must reflect this fair value difference, right? So fair value difference is basically, so when we speak of fair value difference, we're essentially talking about the difference between fair value and the book value, right? Fair value and book value. So if fair value is more than the book value, then the item is said to be understated. As always, the stated value is the book value. So if fair value is more than the book value, that item is said to be understated. If, on the other hand, fair value is less than the book value, then the item is said to be, any guesses? Overstated. Now, if I have an understated asset, the asset's value is actually more than the book value, then when Alpha Limited purchased its portion of Gamma, will Alpha Limited have paid more for that asset or less for that asset? Assuming that Alpha paid what the asset is worth. What is the asset worth? When I speak of the word worth, what value am I referring to? When we say in general what something is worth, what amount would we be referring to? So you're saying fair. Feroz, so try to stay with me here, Feroz. When I speak of what something is worth, how do I determine what something is worth? So I can say my beat up 2008 Toyota Matrix pockmarked with hail damage and rust is worth $20,000. Will I be making an accurate decision? Will I be making an accurate statement? So what something is worth has got to have some reference, as Isaac is saying, to the fair value. Fair value is essentially reference to what the market value of something is, right? So if the asset is worth more than its book value, will I, as a buyer, if I was going to buy the asset, will I need to pay fair value for the asset or just the book value? Fair value. Now, if with the reference to the asset, if an asset has fair value that is greater than book value, with reference to the book value, will we pay more for that asset or less for that asset? More, right? So that is important. So thank you. We will pay more. for the asset. Now, if the asset had been overstated on the books of the investee company, i.e. fair value lower than book value, will we pay more than book value for that asset, or will we pay less than book value for the asset? Less. So you're kind of getting the picture here. So for assets, if the asset is understated, we will pay more for that asset. If the asset is overstated, we will pay less for that asset. Now think about liabilities. Liabilities are just the mirror opposite of assets. So you're taking over the liabilities of the business. If the business has liabilities that are understated, when you value that particular business, will you pay more for that business if it has understated liabilities? You'll now be responsible. When you buy the business, you're going to be responsible for its liabilities as well. So if you know that the business has understated its liabilities, will you pay more for that business or something else? Less. Makes sense, right? So understated liabilities, you'll pay less for them. If the business has overstated liabilities, then of course you know that the liabilities are not worth as much as the business is carrying them at. You will be willing to pay more for that business. You'll be willing to pay, not that you will pay. You'll try still to negotiate, but this is how things will play out. So this 2x2 is something that I hugely recommend that you try to internalize. That whenever we are talking about fair value differences, they will either relate to assets or liabilities. And with regards to assets and liabilities, either there will be an understatement or an overstatement. If fair value were equal to book value, then there is no fair value difference, right? Fair value differences can only exist if fair value is different than the book value. If fair value were equal to book value, fair value difference will be 0, right? So fair value differences will always relate to understatement or overstatement, and they could relate to assets or liabilities. Okay? This is a very important concept that we will need while consolidating, while we learn about consolidations. And it also applies here in the world of the equity method. So are we comfortable with this part? How to figure out fair value differences? Yes? Okay. Now, let's go back and try that out. Inventory fair value exceeded book value by 50,000. So just give me the sign. Will this be plus or minus? Inventory is an asset. Fair value exceeded book value. So this will be a plus, says you, right? The inventory is understated. Equipment, fair value exceeded book value 500,000. What will this be? Same, says you. It's an asset and it's understated. Long-term debt with fair value exceeding book value. So this will be a minus, right? So the sign here will be a negative because we are talking about an understated liability. So that's precisely what I've got here. Inventory, the fair value difference, 50,000 is positive. Equipment, the fair value difference, 500,000 is positive. Long-term liabilities, the fair value difference here is a negative. If you add up these amounts, we get a subtotal of $475,000. That is for all of Gamma Limited. alpha has only bought 20% of gamma. So alpha will pick up 20% of the fair value differences, and that's $95,000. Okay, is that math understood? So essentially in a narrative form, because Gamma Limited has inventory that is worth $50,000 more than its book value, it has equipment that is worth $500,000 more than its book value, and long-term liabilities that are actually worth $75,000 more than the carrying amount of those liabilities. Gamma Limited's net assets have a total fair value of $475,000 more than book value. When Alpha purchased 20% of Gamma's shares, Alpha is expected to have paid 20% of 475,000 or $95,000 more than the book value of Gamma to buy those shares. But by how much did Alpha overpay? The actual amount of the overpayment is 400,000. We tried to explain why Alpha had to pay more than book value. We were able to find out $95,000 worth of the difference. What we could not explain, so out of 400,000, we were able to explain $95,000 as relating to fair value differences. What we couldn't explain is goodwill. Right? That's how we need to understand goodwill. Goodwill is the difference between the acquisition cost and the fair values of all identifiable assets and liabilities. So here, Alpha Limited actually paid a goodwill off, or like ultimately it cost Alpha $305,000 more than the identifiable assets and liabilities. So essentially, Alpha has goodwill of $305,000 in the investment account. Keep in mind, goodwill is not recorded separately, though, under the equity method. Essentially, we only have two accounts that we can use under the equity method. Those two accounts are the investment in associate, which is the balance sheet account, and the investment income or loss, which is the income statement or statement of comprehensive income account. Okay. Is this part understood? All right. Now stay with me. These fair value differences, they will disappear over time. Fair value differences are amortized over, so for assets, they are amortized over remaining useful life, or if the asset is sold to third parties. So either the asset is sold to an outside party, or the asset is depreciated over its remaining useful life. So if you think about inventory, what's going to happen to the inventory? The inventory gets sold to other parties. So this fair value difference on the inventory will be amortized, will disappear as the inventory is sold to an outside party. For the equipment, either the equipment was sold to an outside party, or because the equipment is a depreciable asset, as the equipment is depreciated, the fair value difference will get amortized. So if you go back and take a look, inventory, we're told all of this inventory was sold to outside parties by December 31st, 2002. So the fair value difference on the inventory is amortized in 2002 entirely. For the equipment, the $500,000 of fair value difference will get amortized over the remaining useful life of 5 years. 500,000 divided by 5 works out to $100,000 every year. So each year, Alpha will have to record additional amortization at their own end for the fair value difference, $100,000. Is that okay? So inventory is sold in 2002, equipment depreciated. For liabilities, the fair value difference gets amortized over term to maturity. So Isaac's asking, is it straight line? We'll just assume it's straight line. Like it doesn't have to be, but then we'll be opening up a Pandora's box. So for this course, we will make those simplifying assumption, but we'll use straight line depreciation. Okay. For liabilities, note that under IFRS, we are supposed to take effective interest method. However, for this course, to keep things simple, we will assume straight line. All right. Just to keep things simple for this course, we're learning the concept. I don't want people to start freaking out because, oh, goodness gracious, now there'll be like amortization schedules, etc. As such, there's a lot. Like this part is relatively easy. You know, when we get to consolidation, it's going to be a lot. So I don't want to scare people away. For this course, we will use straight line for liabilities as well. For liabilities, IFRS requires the use of the effective interest method, but I'm going to dispense with that requirement. All right. So coming back to the liabilities, long-term debt, it matures December 31st, 2005. Date of acquisition, Jan 1st, 2002. So what's the term to maturity for these liabilities? From January 1st, 2002 to December 31st, 2005. How many years is that? 4. Thank you. Sometimes I see people going 2005 minus 2002, 3 years. And they forget the fact that the acquisition happened at the beginning of the year, right? So it's better to count on fingers, right? 2002, 3, 4, 5, 4 years. So this $75,000 of the fair value difference will be amortized over 4 years. So amortization of fair value differences for the inventory, the entire 50,000 is amortized in 2002. For the equipment, 500,000 divided by 5 years, that's $100,000. And for the long-term liabilities, negative 75,000 divided by 4, you get negative 18,750. These three added together gives you 131,250. Now, a little word here. These three added together, if I was to add 50,000, 100,000, and this negative 18,750, it actually works out to 131,250. Yeah. Now, if that is the amount of additional amortization, what does amortization do to income? Reduce, right? So because I'm making an adjustment for extra amortization, that is why I subtracted the total. So notice here in the formula, it's minus the sum of these guys. So the result of this adjustment will be to reduce the amount of net income from gamma that will be attributable to alpha. Alpha will pick up 20% of gamma's adjusted net income. So part of the adjustment is the adjustment for amortization of fair value differences. Okay. So maybe I'll just put a comment here. Amortization reduces net income, hence now what's remaining is the intercompany profits. So with regards to intercompany profits, I've got a little blurb here. Intracompany profits arise from sale of goods or other assets between the companies. So remember, the word profit implies, now it could have been a loss as well, all right? So a loss is just the opposite of a profit. So I'm not excluding, I'm not saying that there can be no intercompany losses, right? So I'm just trying to keep things simple and on the narrow path. So if you think about the word profit, the word profit requires there to be revenue and there to be some kind of a cost, all right? Or if you're talking about ancillary transactions like the sale of equipment, etc., there will be some book value and some other sell price. So whenever you have a difference between the selling price and the cost or book value of the asset sold, it will result in a profit or a loss, right? So intercompany profits, they arise from sale of goods or other types of assets between the two companies. So here the two companies are alpha and gamma. So either alpha could sell inventory or assets to gamma, or gamma could sell inventory or assets to alpha. They'll both be seen as intercompany transactions. And if there is a profit amount, as there's a profit element involved in such sale, that will be the intracompany profit. Now, these intercompany profits are considered to be unrealized at the time of intercompany sale. So what does it mean? The profit is unrealized. It's nothing but a paper profit, a make-believe profit from the point of view of the two companies. Hugo, isn't a profit realized offset by the loss of the other? I don't understand why the other party will lose necessarily. So if, for example, Alpha sold a machine to Gamma at a profit, at a gain of 100,000. Alpha is making a gain. Why is Gamma losing? Why is Gamma losing? I mean, so Alpha's book value was 100,000. The machine is actually worth 200,000. So Alpha sold the machine over to Gamma for 200,000. Right? sometimes our brain starts playing games, tricks on us. It's not, that's not what I'm implying, right? This is not like a, gun next to your head and saying, make you an offer you cannot refuse. That's not what's happening here, right? So assume this is a regular way transaction. One company is selling an asset over to another and records a profit. It could be a loss as well. The other party is not a fool, right? The other party is not necessarily at the losing end, right? If alpha and gamma had not been associates, then this transaction would have been perfectly fine, would have been perfectly kosher. It's only when alpha and gamma become associates that there's a certain, and I mean it in a very, very, very chaste sense, there's a certain incestuous kind of an aspect that enters the fray. So like almost like, I sell my beat up car to my wife at a profit. Like my wife and I are together one economic entity, right? We're a single family. So I might think I've sold my car at a profit to my wife, but in reality, I'm just fooling myself, right? So that's basically the logic for why these intercompany profits need to be taken out, right? They got to be taken off because they are considered to be unrealized until either these assets are sold to unrelated third parties. So we can actually only earn profits when the sale happens to an outside party or the asset is used up. So for assets, that happens when the depreciation is recorded. So similar idea to the fair value differences amortization. The intercompany profits, they are unrealized when the intercompany sale is made. Later on, when the goods are either sold to an outside party or the asset is depreciated, a portion of that profit gets realized. This is, again, something that we will be dealing with a lot, okay, a lot. So it is important that you that you try to wrap your heads around it. It's like, it's not just the what do I need to do, but also why am I doing this? The two companies are related companies. They are associates. Hence, whenever there's a transaction between the two companies and one of the companies records a profit, that profit isn't real. It's unreal, if you will, right? It's not real. So that is why what we must do is undo the effect of that. Exactly. It's basically a non-arm's length transaction. That's right. You've hit it right on the head of the nail there. So yeah, so at the time the intercompany sale occurs, we will adjust for the profit element. So it's a question of timing, right? It's a question of when, not if. If alpha sold goods to gamma, at the time the goods are sold, the profit recorded by alpha is unrealized. But later on, when gamma sells those goods to an outside party, the profit becomes realized. It's just a question of timing. All right? When the sale is made, hold back the profit. Later on, as the profit is realized, add it back to investment income. Okay? So let's take a look here. In 2002, Alpha Limited sold goods to Gamma for $150,000 at a gross profit margin of 30%. Remember, gross profit margin is always calculated on the selling price. The gross profit margin of 30%. If the selling price is 150,000, the gross profit would be 30% of 150,000. $45,000. Out of these goods, Gamma sold 70% to third parties during the year. So out of that initial profit, 70% has already become realized because the goods have been sold to outside third parties. So how much remains unrealized? If 70% of the goods have been sold to third parties, what percentage of the profit remains unrealized? Two choices, 70%, 30%. What do you think? 30, says Feroz. What do the others think? $30 as well? So that's precisely it, 30%. So 30% of the $150,000. Well, first of all, this 30%, I'm talking about the gross profit margin. So out of 150,000, 30% was a gross profit margin. So 30% of $150,000, the amount of the profit was 45,000. Of this 45,000, 70% got realized. So 70% of 45,000 is $31,500. The difference is the amount of unrealized profit. Unrealized profit in downstream ending inventory. Now, downstream, it's when the investor, which is alpha, sells to the associate. That will be a downstream sale. So that's exactly what had happened. Alpha sold goods to Gamma. So that would be a downstream transaction. If Gamma had sold to Alpha, it would be called an upstream transaction. Okay, again, it doesn't matter as much right now, but when we get into the world of consolidations, there'll be the parent company, there'll be the subsidiary company. If the parent company sells to the subsidiary, it's called a downstream transaction. If the subsidiary sells to the parent company, it's called an upstream transaction. And in the world of consolidations, it matters whether a transaction is upstream or downstream. All right, so I'm just trying to get you folks familiar with all the jargon as well, right? So when you hear me use the word downstream here, it's the investor company, the company that owns shares in the other company, selling goods or an asset to the other company. Upstream would be the other way. Can you put in your own comment, Feroz? All right. Now, second thing, when I'm calculating, when I'm making adjustments to net income is after taxes. So when I make adjustments for intercompany profits, I need to make sure that the amount of the adjustment is after taxes. So these companies have a tax rate, the two companies have tax rates of 40%. Both companies have a 40% tax rate. So on the unrealized downstream profit, 40% taxes works out to $5,400. 13.5 minus the 5,400 gives me after tax unrealized profit in downstream ending inventory, $8,100. If investor sells to associate, it is downstream. If associate sells to investor, It is upstream. Okay. And we must make adjustment using after-tax amounts. Likewise, there was a patent sold during the year. On July 1st, 2002, Gamma sold a patent with a book value of $60,000 to Alpha for $100,000. Of course, there will be a profit recorded by Gamma. Gamma would be recording a gain on sale of patent, $40,000. That patent, we are told, has a useful life remaining of 5 years at the time of sale. So at the time of sale, 5 years remain. So again, for this patent gain, at the time the patent was sold, the gain is considered unrealized. However, as the patent is amortized, a portion of the gain becomes realized. All right, so this gain, $40,000 in total, will become realized over 5 years. So 40,000 divided by 5 gives me $8,000 for each year. Now, a year, remember, has got 12 months. The intercompany sale occurred on July 1st. The year end is December 31st. So for 2002, the realized gain will only relate to the period July 1st to December 31st. And that is how many months? 6 months. Fantastic. So the calculation here, the gain on sale of the patent, the sale occurred on July 1st, 2002. The total amount of the gain was $40,000. Of that $40,000, the amount of the gain that was realized in 2002, 40,000 divided by 5 times 6/12 to prorate for the 6 months, we get $4,000. So the amount that remains unrealized at the end of 2002 is $36,000. So at the end of the year then, 36,000 is the before tax amount of the gain. Tax at 40% is 14,400. After tax amount of the gain, $21,600. Okay? These two are unrealized gains pertaining to transactions that occurred in the current year. So when we go back, we have to make adjustments for them. In both cases, these are unrealized profits, unrealized gains. And what did we say? What should we do if a profit or a gain is unrealized? Well, firstly, think about what does a gain do to net income? If I included a gain in the net income number, it made the net income number higher. Now, if I'm saying the gain is unrealized, what must I do to the net income to fix it? This is an adjustment for that gain. And I'm saying that gain is unrealized. It's not real. It's make-believe. Should not have been included. So what should I do to adjust it? Brittany says subtract. What do the others think? So the others are not as risk-taking, or are we still thinking? Lovely says subtract. Okay, one more. Okay, Dan may say subtract. All right. Okay, you guys are good. Okay, yes. So yes, we will subtract because these gains should not have been included or should not be included in the investment income for now. Later on, when the ending inventory from 2002 is sold, so when will that happen? Most likely in 2003. So next year, when this inventory is sold to outside parties, the gain will be treated as realized. So next year, we will add back 8,100. For the current year, subtract. Yeah. So for the ending inventory, we are going to subtract 8,100. Now for the patent, it really is two pieces, folks. So what happened in the current year is there's two things that are going on. One, there was a sale of the patent itself. And so for the sale of the patent itself, you will have actually subtracted $40,000. So let me just, okay, where's my note? Insert note. So for the patent, there are two adjustments. Number one, unrealized gain on the sale of the patent. And number two, realized portion of the patent gain. And it doesn't show up, yeah? Thought it'll show up. Is there a way to make the notes visible? Anyways, I thought there was a way to put in a text box, maybe a chat box, but that doesn't seem to work like this. If I wanted to just bring it here. Apparently can't. Insert, drawing. Okay, I think we should be able to. Oh, no. All right, I don't want to say, waste your time there. Can I copy this? Anyways, doesn't seem like I'm able to go anywhere. Yeah, it doesn't let me do. I'm just getting distracted. Okay, you don't want me to get distracted. So you got my point. Hopefully you got my point. So what we would have done is actually, so this $40,000 actually, when the patent sale occurred, we would have subtracted $24,000 for the unrealized gain on that patent. And then on the $4,000, the portion that got realized in the current year, we will have added back $2,400. Subtract 24,000, add back $2,400. That is the net amount of the adjustment that we are making here, right? So it's the net unrealized gain, and the net unrealized gain is working out to 21,600. But I just want to make sure that everybody's on board. So I'm going to put this here. It's negative 24,000 plus 2,400. Okay, is everybody cool with this, where the 21,600 came from? There's two pieces, right? Okay, so Gamma's net income 600,000, amortization of fair value differences, unrealized profit and ending inventory, net unrealized gain in the upstream patent. Added together, we get the adjusted net income for Gamma, 439,050. And that 439,050, when we multiply by 20%, we get the investment income, $87,810. Okay. So essentially, it's 20% of Gamma's income, 20% of the fair value differences amortization, 20% of the unrealized ending inventory profit, 20% of the net unrealized patent gain. All of these at 20% basically works out to 87,810. All right, so some of you may alternatively have done this. You could have just said, okay, Gamma's share is 20% of 600,000, 120,000. For the fair value amortization, 20%, 26,250. For the downstream ending inventory profit, 20% is $1,620. And this guy here, 20% is 4,320. If you add them all up, you get 87,810. All right. So that, bringing you back to your notes, is basically what it is. Calculation of investment income, investors' share of investees' net income, minus the amortization of fair value differences, minus goodwill impairment, if any, minus intercompany unrealized profits for transactions that took place in the current year, and you'll add realized after-tax profits if there were any. So we had, other than the goodwill impairment, we had pretty much everything in there. And it's all at the investor's share. So Alpha's share was 20%. Okay. Any questions, doubts, thoughts? So we calculated goodwill here, Brittany. Right? Goodwill was 305,000. I think what you probably meant was for goodwill impairment. So if that's what you meant, did you mean about the goodwill impairment or the calculation of goodwill? No, so goodwill calculation is right here, right? We calculated goodwill here. In the computation of investment income, though, we are concerned with goodwill impairment. So goodwill impairment, if that's what you're thinking about, the amount of the goodwill impairment will either be given to you, or you'll be told Alpha tested the goodwill or Alpha calculated the recoverable amount of its goodwill to be 200,000. So if the original goodwill was 305,000, and at the end of the year, if the recoverable amount of the goodwill is calculated as 200,000, and of course the difference between the two will be Alpha's share of goodwill impairment. Now, this goodwill, of course, is Alpha's portion, right? So this is Alpha's share of goodwill. This is not total goodwill. This is Alpha's share of goodwill. Okie dokes, no worries. So let's just wrap this part then. The calculated investment income, $87,810. So investment in Gamma began with 1.9 mil. The dividend of 100,000 will reduce the investment account. Investment income, $87,810 makes the investment account go up. Ending balance in the investment account is 1,900,000 minus 100,000 plus 87,810, 1,887,810. This amount is reported on the balance sheet, statement of financial position, 1,887,810, and the investment income from associate, 87,810, is reported on the income statement portion. So the answer to the question was just this, but to get to that answer, there's a lot of work done.